Welcome back to Red's Roundup. In this video, we're looking at the makings of a multi-bagger, the best performing stocks over the past 4 years by Attila Fox Capital. If you want to know what the best performing stocks are, let's stay tuned. So we're going to start here with the project overview. This is what they did. They analyzed the highest performing stocks over the last 5 years and identified their common characteristics, trends, and catalysts. Why? To identify strategies to find the next set of high-performing stocks. How? They researched the businesses of each company individually, compiled quantitative and qualitative data from each of the companies, analyzed it, and drew conclusions. And then at the end, we're going to have 5 high-level takeaways from the framework to screen for future multi-baggers. All right, so here's what they did. They used only stocks domiciled in North America, Western Europe, and Australia. All sectors excluding, this is key, energy, materials, and financials. They targeted a total shareholder return from 6/8/2015 to 6/8/2020 of greater than 350%. Now that's a pretty large return. That's much larger than the S&P 500. They positive trailing 12-month EBITDA, a market cap of greater than 150 million US dollars and less than 10 billion. So this is focused generally on the small cap companies ending in the screen. So this is a small cap screener. Average daily value traded over $200,000. The last fiscal year-over-year revenue growth was positive. The stock is actively being traded and it's the primary security for the company. Okay, so here's the process. This isn't really important, so we're going to continue. So here's the industry breakdown. Now this is key. When you're finding multi-baggers that you want for your portfolio, here are the sectors that you want to be looking in most likely. Technology coming out at 34%. Healthcare, number 2 at 23% of these top performers. And then consumer discretionary at 21%, and then industrials, and then consumer staples, and then lastly communications. So we see here, if you're looking for a multi-bagger and you're only looking in consumer staples, for instance, you're not going to have a very easy time. But if you're looking in tech, healthcare, or consumer discretionary, you've got a pretty wide range of companies available that are multi-baggers out there. So we see here tech and consumer discretionary, and that's where most of the multi-baggers come from. That's where I'm going to be focusing my new stock research in these industries to try and find these high multi-baggers. And it's really only tech and healthcare that outperformed their set of investable universe companies. So there are more multi-baggers from tech and healthcare than would be proportionate, and less in these 4 industries. So those tech and healthcare are overrepresented in the multi-bagger category. That's an interesting thing. You're going to want to screen for tech and healthcare companies. Okay, geographic representation. So continental breakdown. We have most of the companies coming from Western Europe, actually. That's interesting. You might think that if you live in America like I do, the United States might be the best place to invest. It's by far the easiest place to invest if you are American, but that's not necessarily where the best returns come from. We see here that a lot of the great companies are actually from Western Europe. And we see here Australia makes up a sizable portion, and North America. So that's interesting. That is interesting here. But then again, we see here in the country breakdown that the biggest returns do in fact come from the United States as a whole. But if you're going to be looking by continent, Western Europe is good. If you're looking by country, the United States is still probably the best. And then relative to total investable universe, the United States underperformed in terms of these multi-baggers. The UK, Sweden, Australia, Germany, Norway outperformed. Canada, France, Denmark underperformed. Ireland, Austria, and Luxembourg overperformed. So this is an interesting thing. If you want to be looking for multi-baggers, you're going to be able to find them in unsuspecting locations in Western Europe, in Australia. I would say if you're an American like I am, or wherever you're from, you might want to look in some of these foreign markets for multi-baggers. I'm going to be definitely trying to do that coming up. Okay, let's look at the next one, stock exchange representation. What stock exchange were these companies on? So we see here, sorry for that voice, but NASDAQ making up over 1/5 of the exchange volume of multi-baggers. Next one, AMI, I think. I'm actually not familiar with this exchange myself. OMX. I'm not familiar with that one either. That tells you I've got a big American bias towards my stock info. I do not know either of these exchanges well at all. ASX. Here's the New York Stock Exchange. I was really surprised by that. We have the NASDAQ all the way up here, but then all the way down here at 6%, we have almost 7, we have the NASDAQ. That's really surprising to me. And then the Toronto Stock Exchange. So if you're only looking at the NASDAQ and the New York Stock Exchange, you're going to be missing out on quite a few companies. And if you're only looking at one of these other minor exchanges, you're going to be missing out on even more. So that's important to note, that you're going to want to look at a number of different exchanges. All right, here's another key. All of these are key because this presentation is so great that I just had to make a video on it. The size of the company. So we see here we have NanoCap on the right, and this is where they started in 2015 in the blue, and then in the red here on the right we have where they are currently in 2020. So this is interesting. A number of these companies started off as less than $50 million of market cap. And even micro, nano, small, it's really skewed towards that lower end. If you're looking for the multi-baggers, like I've said in my earlier videos, you're going to be much better off looking at a larger investable universe like the nano cap, micro cap, and smaller cap, where the big boys aren't playing in the larger cap area. Because we know that these investment banks, these other buy-side analysts are all looking at the large cap stocks predominantly, and there aren't very many analysts looking at these small, nano, micro cap stocks. And if you're going to be looking for outsized return, you have to look in unique locations. Like if you're hunting for gold, you aren't going to go look where everybody else is looking. You're going to want to go find your own gold mine, and that's where the big riches are going to be. And then we see the total shareholder return breakdown. We see the nano cap stocks actually had the highest total shareholder return out of any of these stocks. That's really interesting. And that confirms some of the portfolio decisions that I've been making over the past months and years, that nano cap is really the way to go. Because if you're looking for total shareholder return and you have a sound company, a sound business, nano cap is going to be a great place for that money to work for you. And what are the conclusions they make? Investors need to be willing to look at small, underlooked, and uncovered stocks to find some of the biggest winners. But that being said, there were also market cap outperformers with over $1 billion of market cap, Etsy, JD, etc. Next slide here, we have financial markets revenue breakdown. So again, skewed towards smaller, but they end up a little bit larger. Again, the EBITDA breakdown for the start of the time period in 2015 is pretty wide open, but then it skews way towards the large end. I don't think this is the greatest stat to be looking at, but it is key. Now here's an interesting one, gross margin. This is important when you're looking at the competitive advantages of a business. You want to be looking at increases in their gross margin. And we see here that these companies had pretty large gross margins on average, and in the 75th percentile for sure, of 61% going up to 66%. We see that these companies on average increase their gross margin over time. And we see this for their other margins as well as EBITDA margin. They're increasing their EBITDA margin. So if you're going to be looking to screen based on a company's margin, this might be a metric to look at, the EBITDA margin and the gross margin for your screen. What caused this set of companies to outperform so much? So here we see right here on the left, the S&P 500 returned 55.45%, while this set of companies that they were looking at returned over 922% on average. So massive outperformance of the S&P 500 over 5 years from these set of multi-bagger companies. And we see here the top stocks of the set: Xenex Medical, Endor, and XBEC. I don't know any of these companies particularly well, but that is a massive return, almost 100 times your money in 5 years. That's pretty good, I'd say. I haven't ever gotten something like that. Now let's look at the next slide. What drove the total shareholder return? Was it EBITDA growth? So that's increasing their operating earnings, operating cash flows. Was it dividends? Or was it multiple expansion? So that's if a company trades at 10 times of their EBITDA or 10 times of their earnings. That's what they mean by multiple expansion. Increasing that from, say, 10 times to 20 times is defined as multiple expansion. So this is growth in actually the business and how well the business is doing, and this is growth in how the market is valuing the business. So over time, as Ben Graham says, the market is a weighing machine. How much does the market change their multiple for the business? How do they value the company? And we see that most of the return is actually from multiple expansion if you look at the median company. So you're looking not only for a company that is going to grow their EBITDA, grow their operating earnings, but also a company that is going to be undervalued a little bit. Maybe not cheap, but at least undervalued, where their multiple can expand many times what it currently is. So on average, you want a company that's cheap for the growth that you think they will attain. That's interesting. And multiple only contracted for 11 of the companies, which is interesting, that you really want to be looking for a company that's going to increase their multiple, increase the price that the market's willing to pay. So next year we have revenue, and EBITDA growth. So median revenue grew from 113%, and median EBITDA grew 137%. So this here, that's great, so that we can see the total of how much the revenue growth was. But here, this is where I really want to focus. Revenue growth, average yearly return. So we see here the 50th percentile, so that's average. The average company in this multi-bagger universe is actually growing their revenue at 20% per year. Now that sounds like a lot, and that's because it is. That's a lot per year. And then if we look down here at the EBITDA, they're growing their EBITDA at 28% per year. Now that's massive EBITDA and revenue growth. So you really need to be finding a company that's not fully priced, but is also going to be growing at a massive rate. And that's going to be really hard to find these days, considering most growth stocks are fairly heavily priced as is right now. So what drove the EBITDA and revenue growth that we saw in the earlier slides? So companies often made acquisitions. Now this is something that you'll hear a lot about. You don't want to see companies making acquisitions. It's usually bad. That's what you hear a lot of in advice from people. But this is actually, turns out it's not true, because over half of the companies made an acquisition on this list of multi-bagger companies. Now that's interesting. And then percentage of companies who not only made one acquisition, but at least one transformative acquisition to really change the company significantly. Now that's interesting, because a lot of times that's the opposite of what you would think. But acquisitions can actually create a lot of shareholder value based on this interpretation of the data of the multi-baggers. So new products, 27% of the companies had transformative new products. 17% of the companies had major new contracts. That's interesting. And then 17% of the companies benefited from COVID-19 related demand. That's also interesting, that if you're going to expect a massive return for a company, you could have that return while other companies are going down. Your company is improving. That's an interesting thing. That's competitive advantage. So this is part 2. Companies levered barriers to entry, which impeded new competitors. So 42% of the companies had high barriers of entry to their business. So this would be, for example, a utility company has really high barriers to entry because it's actually a government regulated monopoly. So you're looking for industries where the barriers to entry are really high, where other people can't erode your economic profits over time. So that's really your real profits over time will be sustainable. This is what people like Warren Buffett, Charlie Munger look for in businesses like Coca-Cola, where they see that that business has a great competitive advantage, that Warren Buffett said he could be given $100 billion and he couldn't erode Coke's market share. That's how you know it has a great competitive advantage and it has high barriers to entry. And percentage of companies where the barriers of entry were assessed as medium. So you're looking for medium or high barriers to entry. And if you don't have that, you may as well just move on almost. It's going to be really hard to find a company that's going to be a multi-bagger if they don't have high or medium barriers to entry. And 91% of the companies had at least moderate competitive advantages. So examples of a competitive advantage: network effect, cost advantages, intangible assets and other advantages, and switching costs related to their products or services. Now that's a great thing too. You may as well not be investing in a company if you want it to be a multi-bagger if it doesn't have sustainable competitive advantages. Listed examples listed here. So that's a great to remember too. Okay, valuation multiples. This is going to be really interesting because you hear me and other people talk like, okay, value investing is the best way to go. But sometimes in value investing, you have to be willing to pay for growth that will be happening in the future. So we see here, even the revenue multiple, over 1 times revenue for many of the companies in this screener. A lot of times that's even a bit aggressive. And then you see here in the EBITDA multiple, you're paying 10 times EBITDA. That's pretty aggressive. And then in the PE ratio land, 75th percentile company is at a 27 PE ratio. Now that I would think that's really expensive. I would be a little bit hesitant to invest. But in this case, in this screener, that's something that you want to be almost attracted to, that you have to be willing to pay up a little bit for this growth at a reasonable price. That's really interesting. If you're willing to pay up for growth, you're going to be rewarded if you are correct. Now that's a big if, but if you are correct, you'll be rewarded. So here are the high-level key takeaways. You have to look for businesses with advantageous positioning. 80% of businesses had moderate to high barriers to entry, and 91% had moderate to high competitive advantages. That's key. Spend time on financially healthy companies. 88% of outperformers came from a position of financial health in 2015 and grew faster than the market had anticipated. So look for financially healthy companies. Acquisitions can create value. That doesn't mean they will. That means they can. While many acquisitions fail to create value, the highest performing stocks often leverage acquisitions to bolster their returns over time. If you're looking for phenomenal returns, find companies that make strong acquisitions and will increase your odds of success. Don't rely on multiples. While it's easy to always buy a better business at a low multiple than a high one, many of the top performing stocks began with already healthy multiples. These multiples often expanded even further. This is important to note. If, say, we were in a long-term bear market where the multiples weren't expanding market-wide, this may not be the case. This is the only instance where I say be careful, because if we aren't in a long-term bull market like we were in the past 5 years, one of the greatest bull markets of all time, maybe this multiple expansion would not have been such a good source of total shareholder return. Okay, be open to international companies. Many of the best performing companies were American, 32%. However, the USA was underrepresented in the stat like we saw at the beginning of this presentation, meaning it is less likely that a company in America would achieve greater than 350% returns compared to some other countries such as Sweden, Australia, and Germany. So after these 5 high-level takeaways, what do you think about this? Leave me a comment. Okay, specific takeaways. These are different than the high-level takeaways because these are more specific. Companies in the UK, Sweden, Germany, Norway, and Australia. Look for these countries because they're going to be, on average, overrepresented in the multi-bagger sphere industry. Look for companies in tech and healthcare. Like I said before, consumer discretionary will be available, but tech and healthcare are going to be your best bets. Companies with market caps below $2 billion. If you want to make money in the stock market, significant money from multi-bagger companies, you need to look at small cap stocks, is essentially saying. Companies with below $2 billion market cap represented 84% of the stocks in the set. So in my screens, like I've been doing this for a while, I don't even really look at companies over $2 billion. I haven't been looking at over $10 billion, but for sure, now, I'm not going to be looking over $2 billion, really, very intently. $2 billion is kind of a key number here. Companies trading below 3 times sales and 20 times EBITDA and 30 times PE, or those without forward multiples. 82% of companies from the set traded below these numbers of multiples. So now here, back to the value part. You can't pay for everything. You need to pay a price for everything, and you can't pay unlimited sums of money. So here we're saying try to avoid paying greater than a 30 times PE ratio, because over that you're getting into some pretty extended territory that might be getting closer to fully priced. And if you're below that, you're going to be pretty well off. So this was my overview of the Attila Fox Capital presentation. I encourage you, the way I found this was actually through their Twitter at Attila Fox Capital. I will link all of these presentation, Twitter, and their website in the description below. Please subscribe if you'd like to see more, and comment, tell me what you think of the multibaggers. Thanks.